Well, hello everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted that you are joining me today to talk about Fibonacci's. So today we're going to talk about Fibonacci retracements. We're going to talk about when a trader might choose to use them. We're going to talk about just what a Fibonacci retracement is. If you're brand new to this tool, fear not. I'm not expecting you to know anything about it out of the gate. And we're going to take a little bit of a trip back in time to talk about, how Fibonacci retracements kind of came to be. So having said all of that, I'd like to invite you to join me in the land of X, formerly known as Twitter, my handle at Barb Armstrong CS. We also have the pleasure of having Cameron May with us in the chat today, which is just a teensy bit intimidating for me because he used to be the driver of this class for many years, and he's taught some really great introductory classes on Fibonacci. So if you want more at the end of the day, you can always go to the Trader Talks playlist and do a search for Fibonacci retracements and get another perspective on that. Okay, but for sure, Cameron understands this strategy inside and out. So you're in good hands in the chat. Everything we're going to look at today is for general information purposes only, none of it to be construed as a recommendation on the part of Schwab or myself. If we do discuss options, know that those carry a high level of risk and are not suitable for all investors. Actually, we're going to do both an option example and a stock example today. And while we focus on technical analysis in this class, because it is called Getting Started with Technical Analysis, other approaches, including fundamental analysis, having a perspective on what is happening globally of late. There's been a lot of talk about tariffs and how those are impacting the markets. So it's important to have many pieces of information to bring to the table. We all are using the Paper Money software application on the Thinkorswim desktop platform. It's a brilliant place to learn. There are a few nuances and differences between that and the live account. We'll discuss those as appropriate. If we use a stop loss order, know that that doesn't guarantee that we will necessarily get out at the price requested. So, we have created this series to be taught in about a 9-week rotation, and I decided to add an extra lesson at the end before we, work our way back to the beginning on Fibonacci's, because this is something that was requested in some of the surveys. And when there is a survey, we do look at those. I read each and every comment, and I'll often create a list. And sometimes we'll have a session I just call You Ask For It, and we'll just answer a bunch of questions or comments that have come up in the surveys. Okay, so let's get out to the platform. I don't have a slide deck that I have created for this, but let's start with Kroger, and I'm going to bring up, I'm going to trade my watch list here for a scratch pad, because we're going to take a few notes. So this is it's Fibonacci retracements. And the way this started was based on a mathematical pattern. Leonardo Bonacci, whose nickname was Fibonacci, was an Italian mathematician living in Pisa, and back in the Middle Ages. So I'm not. I like to say I'm math averse, but this is a man who obviously loved mathematics and, lived from about the year 1170 to about 1240. And one of the things that he noticed was how these mathematical patterns repeated themselves in science and in nature, in the way a sunflower grows, in the ways trees grow, in seashells, that these patterns kept repeating. And so if we start with 0 and then go to 1 And then what you're doing is if you take the 0 and 1 and add those together, you get 1. And then you add the 1 and 1 and get 2. And then you add the 2 and the 1, and that gives you 3. And then the 3 and the 2 gives you 5. And the 5 and the 3 gives you 8. And I mean, this can just, we could be here until the sun sets, which is many hours from now. And it just goes on ad infinitum. And then what he noticed in addition to this, it might help, I guess, if I put a little dividers in here, or little commas, is that if you took some of these numbers like 34 and divided it by 21, it gave you this 161 number. And the bigger the number, it's actually 161.8 is the number we go with, but there's this 161. And so if we're looking ahead, and this is a significant number, with the extension of a Fibonacci retracement. If we go the other way and we take our 21 and we divide it by the previous number, if I divide that by 13, oops, sorry. Let's start that over. If I take my 34 and divide it by 21. Oh, sorry. If I go the other way, if I take 21 and divide it by 34. That's going to give us that 61, and if we round it up, 0.8. And these are significant numbers in our Fibonacci retracement series, this 61.8. And if we go kind of 2, ahead, we go 13 to 34, it gives us this 38.2. And if we go by 3 ahead, so if I take 8 divided by 34, it gives us this, 23. Oops, let me just come down here. All right, 28.2, 23.6, or 0.236. So if we look at, so how do we take these numbers and use them? And if you have never used the Fibonacci retracement, if you come down to your drawing tools and hover over it, you're saying which one is which. Here's our Fibonacci retracement. And if we look at, let's just look at something that has recently happened. So if we look at Kroger, and we have a stock that's been uptrending, and it just came up and hit a new high. If we click on the top and draw down to the bottom, and we're trying to estimate where it might go from here, so if someone wanted to place a trade, let's say this had come down and bounced, and they said, well, where might I put a target? And so if we were looking at entering it on this day after this little pullback, we haven't been here before with Kroger. So where might we place a target? And so by looking at the length of this move, some might put a target here at the 161.8 level. Okay. Now, when this started to pull back, where might one become concerned? And, when we look at these retracement, levels here, this 50% level is often considered kind of, the point of no return. If it crosses below that 50% retracement level, then maybe this isn't a pullback within an uptrend. Maybe it's a change in trend direction. And so if one, say, wanted to be a long-term holder of the stock, they might say, well, I'm going to place a stop loss order below this 50% retracement level. Because if it goes below that, not hopeful that it's going up. And what I find fascinating is how often things will come back to this, 61% level or to the 50% level. And then, if had we set a target at 161.8, would we have hit it? Well, we would have. We wouldn't have stayed there long, but we would have hit that target. And so this is kind of a look back in time at how one might look at an uptrending stock where, it's heading into new territory. And we're wondering, when we have this bullish opportunity, if we wanted to do an intermediate term trade with a target exit, perhaps, how could we establish a target? And this is one of the ways that we can do that. Okay. I'm just looking. Are there any questions on this so far? Okay. Let's come and look at, I have a list. So let's come and look at Dollar General. So we have a stock that, in the last year has been, had a great fall, right? It not only had a great fall, but it's really been downtrending. And then it seems to have kind of leveled out and now might be moving to the upside. But it's been so long since this has been uptrending. When we look at the last year, we've seen downtrend and then long period of consolidation. And so if we wanted to trade this bullishly, how might we establish a target? Well, we had this recent high. And so again, we could, now that we have our tool up, bring it down to this recent low. And if we were to establish a target, where might one of the targets be? And feel free to type this in. So one target, of course, might be this 161 extension. But where else might we see a target? Could we not have a swing target, like trade it back up to this 100% level? And we're looking, when we look at this, and we can see that this is, not the first, in this uptrending series, but, did it pull back more than 50%? Well, it kind of came back down to this 50% level, didn't it? And it kind of, was on this line and then started to rally. Now today, it looks like it's pulling back a little. So, this may in fact not continue up, but could we look at today's high on this if we wanted to place a bullish trade and say, well, today's high is 90.46. If it goes above that by 20 cents, I'd like to get in. I'd like to buy some shares. So at 90.66, and given all the uncertainty in the market of late, and tomorrow retail sales numbers are coming out, so that'll give us an idea of consumer confidence. But Dollar General, we're not talking Louis Vuitton here. A lot of people might argue that although some of the items that one might buy at a Dollar General are discretionary, others might look at it as more the type of place where one goes to buy staples. And, if you're looking for economical groceries, paper towels, trash bags, storage bags, disinfectants, laundry products, I think most people are familiar with Dollar General and its competitor, Dollar Tree. But if people are concerned, might there be more of a migration to stocks that are less volatile in a period of volatility? Yeah, so Steve is saying, maybe in at 86 and out around 109. So 109 is kind of, it's lower than this 161 extension, but you could say, well, often at the $10 marks, there can be, kind of perceived resistance. So just because the 161 extension is 112, doesn't mean that that has to be our target. Our target could be 109 or 110. But according to our long ago friend, Leonardo Bonacci, this would, from a mathematical perspective, be a legitimate target. But so would the 100% level around this 97.85. And so, if we look at this, and some might say, well, I'm going to wait for it to pull back again. I'm going to, if it comes back to this 50% level again, then I'd like to enter. Okay, so we're going to take the approach of today is, a temporary pullback, in this next uptrend, like we saw here, 2 days up, a day back, day up, day back, up, back, up, back. Sounds like some kind of dance routine, right? 2 steps forward, 1 step back. We're all line dancing together. So if we looked at this, we could have one target, and we could place 2 trades, because this is a $500,000 account. So we could buy 100 shares and have our target at 97.85, or we could buy a call and have our target at 97.85, and then buy 100 shares of stock and say, we know that this may well take longer, but we're going to put a target here, on the stock out here at this 112 level. So how might we do that? Well, we're going to come to our trade tab. And, is this heavily traded? Well, it's traded over 1 million shares so far today. If we are buying a call, we'd want to go out at least 20 days plus the number of days we think we might be in this trade. So we might want to come out to May, we might want to come out to June. And if we look at the difference, so where they say time is money, well, if we bought the 90 call, the at the money call, it would cost us $315. Now, what's the disadvantage of buying a call is that if we get to May 16th and it hasn't moved up, then this could expire worthless. With June, we're going to pay more for it, but it has more time to reach the target. But again, we could lose the entire amount. Now, this has a 20-cent bid-ask spread and lots of volume. And this is saying there's a 95% chance. This is probability of it coming up and touching 95. Of 90. It's at 89.15 right now. So there's a 95% chance it will hit that. Now, what's our target going to be, though? Our target is going to be this 97.85. And what is the probability of it hitting that? Well, these are $5 wide spreads. Let's see if we have dollar wides here. Yeah, so our target is 97.85. And 112. So if we come and look at a weekly, so the week before, let's make this 18 strikes. So this is saying we've got about a 48% probability of it coming up and hitting that $98 strike. We've got a 54% chance, almost 55% chance, based on where it's sitting today, of it coming up and hitting the 97 mark. So let's make our target 97. And, this is just a way of trying to assess probability. We're going to buy one contract. So we're buying one call with the expectation, and we know we may have to pay a little more for it. We only want to buy this call. It's currently trading at 89.07. We only want to buy this if the stock goes above $90.66. So I'm going to bring up this conditional order, and I just have to click. I only want to buy this call on Dollar General if the stock goes above $90.66. Which is 40 cents above today's high. So we're looking for that uptrend to continue. And then we can compare this. So this is our long call compared to the long stock. And long just means buy. And this is, it's basically what we call a swing target or the previous high, which is what a swing target is. So Andy is asking, how is the probability of touching different from delta? So what delta technically means is the delta represents the amount this option will go up if the value of the stock increases by $1. So if this Dollar General goes up by $1, the value of this option will go up by 52 cents. The probability of touching is in the next 66 days, the probability of this coming up to 90 is 95%, because it's almost there now. And in fact, we don't even want to place the trade unless it goes above 90.66. But what this does is it gives us the right to buy the stock at 90. And our expectation is that it's not going to take 66 days. Our expectation is that it might go up in the next 10 days. But we're just giving it a little more time than if we bought the May expiration. Okay, and so if this goes up in the next 10 days, and so here's another thing that we can look at. We could come here to Theo, Price, and Mark and say, the first thing we're going to do is hit reset. And then we're going to say, okay, our target on this, and actually I didn't put our target in, did I? So let's just come in. And I'm going to cancel this, and we're going to go in and put our target in. So we're going to buy, and we're going to buy custom with an OCO bracket. And we're only going to buy if this goes above $90.66. And then we want to sell when? Well, we want to sell when it gets back to the previous high. So we don't know exactly what the option will be worth, but we're going to say we want to make this a market order to exit at $97. It's currently, and we're only going to enter this trade if it goes above 90.66. So if and when it gets up to $97, which is the previous high, then we'd like to buy. We'd like to sell it, sorry. Okay, and then when do we want to exit? Well, if we get in, if we base it on the current price and the expectation is, now it can change based on volatility, and volatility, there's been a lot of talk about how high volatility is. But if we just put in a ballpark, and we can always change it, say, hey, if it loses half its value, so if it becomes worth $3.15 or less, or $3.10, that's about a 50%. That would be about a 50% loss. Then we'd like to exit. And so when we look at this, we want to buy a call on Dollar General only if it goes above 90.66 to enter the trade. And we want to get out when it hits our target at $97, or if it loses half its value. And, that may, we may get into that tomorrow, or we may meet next week and just cancel it and say, ooh, it ended up not going, it ended up pulling back and not going back up where we thought it was going. And we could choose to just exit that, cancel this conditional entry. And we can compare this to our long stock. Now, the reason I did an option trade, because I don't often do option trades in this class, is because in the surveys, I've had a lot of people say, keep the option trades coming. And other people have said, I don't trade options, they confuse me. So keep the stock examples coming. So I thought today we would do one of each. OCO stands for one cancels the other. And so if we get into this trade and then it comes up and hits our target at $97, then it will cancel the order to exit the stop loss order. Okay. So we're going to do our entry the same way. And this time, because we're buying the stock and we're willing to hold this position longer, and what might contribute to our willingness to own the stock? Well, we may have noticed that, it pays a dividend of 2.6%, and that may be something that's appealing to some investors. Now, one of the differences between a paper money account and a live account is that dividends are not actually paid in a paper money account. So we don't get our paper money dividend in a paper money account. The other thing is that dividends, there's no guarantee that dividends are going to be paid in a live account either. Dollar General could decide to discontinue the payment of their dividend. But that might be a reason for us to be interested in continuing to own the stock, even if it takes a few months to get back up to this 161 level. So if we come to this trade tab, and now we can close this. We are going to right click, and we can right click anywhere. But if you hover over these, you can see this, it'll say we want to buy. And yes, we want to buy. But do we want to buy right now? No. We only want to buy if it goes above $90.66. And I'm going to put this one in like I did the last one. So we're going to buy custom again with that OCO bracket. And we're going to change our limit order to a market order. So I'm going to make all of these good till canceled. We're going to hit our disappearing, reappearing sprocket and say, hey, we would like to buy 100 shares of Dollar General if and only if it goes above $90.66. And then when do I want to exit? Well, I want to exit when it gets back up to that previous high of $1.12, or sorry, to the 161 extension of 112. And if it doesn't go my way, where might I choose to exit? Well, I might say, here's this 50% extension. If it goes 2% below that, so 86.29 times 0.98, if it hits 84.56, so if it goes, and what was our recent low here? It was 84.70. So, if it goes below this low here, basically we want to exit. So we're going to make that. So we're using our 50% Fibonacci retracement, that 50% level, to give us our target. So that's 84.56, our stop. Now, this will generate a market order. So if the stock gap down, there's no guarantee that we're going to get out at this price. But the expectation is that we're defining our risk. Okay? So we want to buy if it goes above $90.66. We want to exit if and when it gets up to 112, or if it goes below 84.56. And again, this is an OCO, order to exit. When one fills, the other will cancel. We're going to put this into our stocks with a target category, and note that this is based on the 161 Fibonacci extension. And then compare to our long call. Now, the long call has a shorter term target, but it might be interesting to see, how that plays out. And others might say, I prefer just to trade stocks, and I'm not sure I want to look at something kind of more intermediate term. So what I'd like to do is make my target the same. We could make that target $97 too. And so when we get to $97, we might look at that and say, hey, do we want to stay in this trade? And so one of the things that we can do is come up here and add an alert. Let's say you're just doing the stock position and say, hey, if this goes above $97, do I stay or do I go? Do I sell the shares and take the swing target? And you don't have to be formal in your note. This is just a note from you to you. And no one else is going to see this. And it depending on how you set this up, it'll shoot you a text or shoot you an email or both. Yeah, can you show how to place the fib on the chart again? Absolutely. So let's come in now, and this is showing where we put this. So if you don't want that to show up, you can say here, don't show alerts. And so let's just remove this drawing and then add it again. And the idea here, let's just come out to that 6 month, is that we're just looking at a recent move. And we're saying, hey, this may be coming around the corner. Now, others may have noticed that, and I'll get to that in just a sec. So if we come back down to this line here, you're just saying, it pulled back and then had this pretty dramatic move up. And then there's our 50% retracement, our 61%. And often, if things are really bullish, it might only come down to this 61% retracement level. Gina is saying, why would you sell if the next target is 112? Well, what if it gets let's say it gets up to 99 and then looks like it's going to start pulling back. So some might say, well, what might happen? And nobody has a crystal ball. Well, I certainly don't. If I did, I might be in the Bahamas right now drinking something out of a coconut. I don't know. But let's say it comes up and then it looks like it's going to come back. An investor might say, you know what? I'm going to exit here, take my unrealized gain, turn it into a realized gain. And then if it comes back down here to this old 100% level and starts to bounce, then maybe I'll draw a new Fibonacci line where I start here and draw it down to here and then place a new target. You know, and others might say, I'm just going to hang in there. And just because we have this target at 112, you know, sometimes things will get really close. Like it might get to 111.50, and then we might get a candle like this candle here that says, hey, you know what? It came close, but not quite there. But this is indicating that this current uptrend may be complete and we may be due for, you know, a bit of a pullback. And so if you get a candle like that or a hanging man, you know, and I've started posting some short videos, you know, a hanging man kind of looks like this when it's at the top of a trend. And so if you see that, you may decide to exit. So just because you have a target, it doesn't mean if it's 50 cents shy of the target that you might not say, or, you know, if things are happening in the market that you're thinking this may end up pulled back in spite of the fact that you had a bullish perspective on it. Okay. Let's look at another stock. So if we look at Berkshire, well, actually, let's look at And, you know, here we had, you know, a stock that was, whoops, let me change my drawing tool. And we're kind of, you know, this is a historical review here, but, you know, we had something, you know, a bit of a double bottom pattern here, and then it broke out and came up. And if we look at this and we say, what might another target be? Here's where we might say, you know, let's visit Mr. Fibonacci. And if it was, we were looking at it on this day, we could come up and say, you know, here was just this short run, but what might the next target be? Oh, look at that. The 161 extension on that would be 539. And what was the target? The target was 540. Where did it come up to? 539. Kind of incredible, isn't it? And then where did this come back to? And this is one of those things where, you know, we've had some extraordinary things happening within our world, but, you know, this came all the way back down to where it started from. Or it came down to the 23% extension, you know, if we just look at the close on this, you know, between the 23 and the 38, but it certainly blew through the 50. And so, you know, there may have been some traders that would have chosen to exit at that time, depending on your perspective. But, you know, if you'd had this target when something broke out, you know, that would have worked out well for you, wouldn't it? You know, but again, you have to be monitoring these things, because if you were just going obliviously on and then all of a sudden this starts to tank and you're going, I managed to snatch defeat from the jaws of victory. So it's important, just because you have a target doesn't mean, you know, it's set it and forget it and you don't have to pay attention anymore. You know, so some might look at this short-term trend. We had this little, you know, kind of double bottom, this little period of consolidation between, you know, the beginning of March and the beginning of this week, where this broke out. And if you're saying, well, do I really want this to be a target? What might a Fibonacci target be? You know, here's our 161. And that's interesting because it kind of coincides with this bottom, this support level. It's in the same neighborhood, isn't it? But again, would you want to place that trade today? Well, given that, I mean, we're just down, you know, $2.44, a smidge, 1/4%. but you might say, I'm going to wait. Yeah. Uh, okay, so somebody's saying, I'm curious why, except for the market movers, people aren't talking about important economic events. You know what? A lot of the instructors are talking at great length about the importance of economic events, and I'm one of them. I teach trading a smaller account on Mondays and Fridays, and then trading price patterns on Wednesdays, which I treat as a companion class to that. And we've had lots of conversations about that in those classes. This is a getting started class. So the idea behind this class is that if you're new to the world of technical analysis, we're over the 10 weeks talking about a different concept every week. So we're talking about support and resistance. We're talking about trend. And yesterday we talked about the trend is your friend, even in times like this, and how to use trend to make short-term decisions. But we've had lots of conversations about what's going on, with tariffs. And I mean, the biggest thing with the last 6 weeks, as we have seen, if we look at the S&P 500, is that the market likes consistency and they like certainty, and and we haven't had as much of that, and the market has not reacted favorably to that. And so could we use our Fibonacci extension, and I'm just going to clear this drawing set, to say, okay, we recently had this pullback, and here we do the opposite. So we're going to start at the bottom and move to the top and say, if we don't think, or maybe we start from here, this most recent one. So where might a target be? And this came up, and this is going to make the bulls happy, right? Because they're going, if this is the point of no return on the downside, it's come past that. Like it on Friday, it blew past that. Like this was one of the biggest candles we've seen in the last 20 years on the S&P 500, certainly one of the biggest bullish candles. And then it stayed above this 50% level. So maybe the downtrend's complete. But if it isn't, if it breaks back below this 50% level, what might a new target be? And for that, we would come up here to our price axis, and we're going to make this an auto and say, hey, rather than 20% up, show us 20% to the downside. And so here might be a target. Now, some might have, again, this 100% level as a swing target and this 161 extension as the next target. Okay, now for an overall view on the market also, in the morning at the market opens, Trader Talks with Kevin Horner. He does a brilliant job on that, and I'd highly recommend it. And because we now have this class to open the markets, we are often spending less time having those conversations in our individual webcasts because, we have a time constraint. So, and again, we could do the same thing on the NASDAQ. So, the fact that it's come above this 50% level has the bulls doing their bull dance, and the bears might be saying, though, we may not be done with you yet. Okay. And the answer is we don't know. But if this starts to come back, where might we have a target? Could be down here. Swing target could be the first target. Okay, guys, so we are out of time. I'd appreciate it if you would hit the like button. It just lets people know that you found this content valuable. I believe that there was a survey in the chat also, so I will repost that. 2 questions. 1, I loved it. 1, I hated it. 10, I loved it. And then there's everything in between. My commitment to you is if you fill it out, I will read each and every question. Next week, we are back to the top of the rotation, so I will look forward to seeing you then. Don't forget to follow us in the Land of X. Hit the subscribe button if you haven't done so already, and enjoy the rest of your day. Take care, everyone. Bye for now.